Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. As I zoom in here, you'll see that I left my lines on the chart from last week, so you can see how the forecast is working out. And I said last Friday, which was this green candle right there, I said we would most likely move up earlier in the week, test this resistance level up there around 210, and then proceed to pull back from that point. Now that's what's happened, and you can see here that we have not yet reached the end of that target, so I'm not going to move that at all. I'm actually carrying that over into next week with my IWM target set below the market at 199.82. If you take a look at the stochastics here, you'll see that the K line, that's the percent K, the blue line is moving lower and it's converging in on the percent D. Once those cross, that's a sell signal. And on Tuesday, the CCI crossed with a sell signal. So the momentum is shifting lower. I'm not budging on that. And we have a slight gap below the market right there at 196.15. Let's take it one step at a time and work for that target first and foremost. Now, if we look at the Qs, ticker symbol QQQ, this is the ETF that basically tracks the tech sector. Pretty much the same forecast from last week. I said we would go up, test that resistance. We surpassed that resistance, but look, we did so on lower volume. And with the lower volume, you could also see down here as I magnify that, the CCI is today crossing with a sell signal. So next week, I expect the markets to pull back just the way IWM is expected to pull back. And there you go with the target still in place, not moving that at all, carrying that forward at 338.39. Now, if we look at the diamonds, this is the Dow Jones Industrial Average ETF. Again, same thing playing out. We are bumping our heads up here against that resistance at 350.56. And the signals are still in place like what we've seen in the other markets, with one exception. Look down below here, and you can see that there is a very steady drop in that volume on the diamonds as we are moving up. So again, all I have to do is just keep that target. I'll even make a horizontal line there, keep that in place. We're basically caught in all of these markets. We're caught in a fairly wide trading range with resistance up here at the top, ultimate support down here at the bottom. Keep an eye on that support level at 322, because if the diamonds drop below 322, that's going to more or less trigger the moving averages, the 100-day and others across the board to cross, and we're going to see some program selling get kicked into the systems from there. But that's a key support level for the diamonds. And again, I would put a price alert on that to make sure that you're managing risk below those levels. Now, I want to hop to the 52-week high-low list, because if you look at the wallstreetjournal.com, it's WSJ.com. I keep the link in the description box below. If you look at the New York Stock Exchange, you're going to see almost an even match between highs and lows, 52-week highs and lows, 169 52-week highs. Down below here, you can see that we had a 187 new 52-week lows, so it's slightly negative there. But keep in mind, that's a negative breadth of the market while we registered higher prices on the Dow. Now, if I go right back to the top and look at the Nasdaq, that's a lot different. In fact, the Nasdaq is showing 95 new highs, 52-week highs there, versus, check this out, you have 185 new lows right there. So the breadth of the market is 2-to-1 to the downside. And that's, again, really important that you use risk management strategies there. You know, when I put these forecasts out and I'm looking at the markets, and, you know, of course I read all comments, and there's some people say, oh, well, you missed this week. You know, when are you going to admit that you're wrong? I do get that, believe it or not. I have to make sure that people are understanding what technical analysis is. Technical analysis is nothing more than the analysis of historic price action and trends. That's it. Just got off a conference call with a group of traders talking about Dow theory. Well, a trend will stay in place until the trend is broken. Now, I want to take a little bit more time on this one because it's very, very important that you understand how trends shift. All right, now, if I go back and look at a 4-year daily chart, this is 4 years, you can see that back here, March 2020, we had that pandemic sell-off. Now, that is not a transition. That is a jolt to the market based on news of a COVID virus shutting down our economy, and that obviously shocked the market lower. At the end of March, we were buying it here. Why? Because the divergences from that moving average was so wide, and it was not a transition. Remember, it was a shock to the market. What we're seeing now in this market right here is we are seeing a trend shift, according to Dow theory, where if you look back at the former lows and you connect these lows, even from the lows of March 2020, and you connect these lows, there's your upward trend. But here recently, we are now below that trend line and we are forming lower highs along the way. And again, according to Dow theory, trends form when you have a downtrend with lower highs followed by lower lows and an uptrend showing higher lows followed by higher highs. Again, this is the transition that I've been talking about. And you can see, obviously, that we have lower highs followed by lower lows. This is a range-bound market that's heading in that downward direction. Hence the reason why I remain bearish and I continue to direct our option traders into bearish spreads. If you're an option trader, this is a field day. I mean, you should be having a field day. Putting spreads on with the premiums that we're seeing and doing ratio spreads and condors and all that, it's a very fun market to trade as long as you are keeping an eye on the charts. Now, going back to that 4-year chart and backing up just a little bit, where else did we see a trend like this, a transition like this? Well, if I go back 20 years on the weekly chart, you can see that back here in 2007, we saw this exact same transition from a bull market. Look at that trend. It broke the trend line and reversed into a bear market. Now, that's when the market dropped 50% in 1 year. That is a significant sell-off in a bear market, and eventually we found the bottom. Right now, I have no sign showing up whatsoever of a bottom forming. Eventually, I think we will, but I don't see that one now, certainly. And you have to keep an eye on the volume as well. Now look at that transition a little bit more closely. This is right into 2007, beginning into 2008. You see how we see higher highs followed by higher lows, and then the shift took place. Lower highs followed by lower lows. It's almost an exact duplication of what we saw into 2008. And I just want to point that out because this, like forecasting the weather, you have to take all data into consideration. Again, looking at a weather report, let me just pull this up for fun to show you what I'm talking about here. Let's say that we're forecasting the weather and the next 10 days is showing, okay, well, on this day, on Saturday, we have a 5% chance that it's going to rain, right? What does that also mean? It means that there's a 95% chance that it's going to be sunny, does it not? Well, if it rains, does that mean the weatherman is wrong? That it was 80% chance it was supposed to be sunny? Or does it mean that you should have brought your umbrella no matter what? I'm not joking around with this to try and make light of what I'm talking about here, but it's a forecasting tool, the charts that is, that gives us data that helps us increase the probability of making money as long as, here's the key part, as long as we are putting our money in the direction of where the money is going. It's really that simple. Now, if I look at the SPY, you can see same transition taking place, right? We see this topping pattern right here as we zoom in. Look at that 20-week moving average. Remember, this is set on weekly chart. We're bumping our heads exactly at the 20-week moving average. And look at the drop in volume over the last 3 weeks. Again, for those of you who were impressed with the rally that we've had over the past couple of weeks, look at the volume. There's no supporting evidence that that will continue. You see that? Now, if I pull back to a daily chart on this and get more into the forecast, as I usually do, you can see, again, we are at a resistance point up here at 457.99. I'm keeping that target in place down below at 430. oscillators are rolling over. The drop in volume overall, the average drop, is pretty consistent right there. And that tells us that there's a weakening in the buy side of the market right here. Now, finally, I'm going to end on this one, is the VIX. The VIX has dropped. It did not go up, but I want to point something out to you right here. Look at the price divergence that we're seeing here from that 20-period moving average. That's the greatest divergence that we've seen all year. And in addition to that, you can see that the oscillators down below are the second most oversold here and the second most oversold on the stochastics for the entire year. What does that mean? Well, when you combine that data, again, like I'm looking at a weather chart, I'm looking at the isobars and the barometric pressure and the temperature changes and such. I look at this chart and I say, okay, well, with these indicators pointing into an oversold condition, what does that candle tell us? Well, that's an inverted hammer. And inverted hammers tend to be bullish about 80% of the time. So again, I'm not changing that short-term target. Some people ask me, when are we going to hit the 4188 level? I'm leaving that in place as well. If you look at the overall trend on the VIX, going on a weekly chart right here, you can see that the VIX, which normally does not trend, happens to be trending. Look, we have higher lows followed by higher highs. The VIX is in a trading channel. That's not normal. The VIX is an oscillating index that measures fear. It's the fear index. But we're seeing a consistent number of red candles, which means on the weekly chart, we are long overdue for a green candle. So again, keep your eyes on the charts. Make sure you're managing risk correctly. I would also caution you not to get caught in any bull traps. And make sure you stay in touch with this weekly market report. Again, thank you so much for following. We have regular followers that comment. They're getting a lot out of this. Thank you so much. Please continue to like, share, and comment. I appreciate that very much because it helps us spread the word and help everyone become more or less an ambassador to technical analysis. So with that, thank you so much. Have a great weekend. We'll talk to you soon. So long.